The amount of income you can generate with your investments at the moment is very low. And I think that's part of the reason why there's been so much interest in yield farming with cryptocurrency. So in this video, I'm going to take a very practical approach to how to go about yield farming, but also to look at what the risks are, because this is certainly not an established market and your capital is very much at risk when you go about doing this yourself. So with that proviso in mind, let's look at yield farming in a bit more detail. Let's start off by looking at what we mean by yield farming. Now, traditionally, the way capitalism worked was to match people who've got capital with those people who need it. And the intermediary was usually a bank. The innovation with decentralized finance is that now we don't need the bank. Instead, we use some kind of technology to act as the intermediary. Now, the theory is that the people who've got capital get to keep more of the gains, and hopefully the people who borrow can do so at better rates. Whether that happens in practice, we'll have to wait and see. Now, the amount of money tied up in decentralized finance at the moment, so that would be for things like yield farming, is fairly small. It's at under $60 billion. But of course, as cryptocurrency values have crashed in 2021, that's reduced the amount of money invested in crypto. But this is certainly something which has been rising very rapidly over the last couple of years. Now, for the purpose of this video, we'll consider two ways in which you can do yield farming. And the first one is by owning cryptocurrency which has something called staking rewards. Now, the idea here is that you can stake your currency holding in order to secure the network itself. And anyone who's got sufficient quantities of the cryptocurrency can take part in staking. Now, if you hold the cryptocurrency ADA on the Cardano network, that's an example of a cryptocurrency which uses proof of stake to validate its transactions. Now, if you're very tech savvy, you could set up your own Cardano stake pool. But for most people, I suspect that's too complex, so they'll delegate their stake to a pool. So the actual decision about which blocks are validated to be added to the blockchain are carried out by these pools. And the incentive for them to do that is a monetary reward. Now, the greater the stake that a pool has, the greater the chance that it makes up the next block and receives a reward. Then it shares out that reward to all the people who delegated their stake to the pool. The second source of income for yield farming is a more traditional one, which is to lend out your cryptocurrency. Why would you do that? Well, some institutional investors, such as hedge funds, may want to short cryptocurrency. In other words, to profit from a falling price. And in order to do that, they borrow your cryptocurrency, they sell it, and then hopefully buy it back at a lower price. Or they may have a long position in cryptocurrency and they'll use your borrowed funds to offset some of that risk. Or they might be borrowing cryptocurrency to lever up their trade and amplify their returns. But typically these loans will be over collateralized. The borrower has to put up collateral either as crypto or fiat currency, so that if they do default on the loan, the loss will be significantly smaller. And of course, that reduces the risk to the lender. Now, the thing everyone's interested in is how much you can make with yield farming. And you can see the interest rates can be very high. So this article in the FT compared some of the largest yield farming platforms, and you can see Celsius is the one which is most generous, or at least that's true at the time this article was created, with an annual interest rate of 17%. Another platform that I'll be talking about is Nexo, which has the second highest rate of interest, which is 12%, and I'll also be talking about BlockFi. But the thing to bear in mind is that these rates are not constant. They'll change all the time according to supply and demand issues. But what is noticeable is that the rate varies quite a lot between different cryptocurrencies. So for example, here you can see that on the Celsius platform in July 2021, you'd have made 6.2% by lending out your Bitcoin. But the yield was even higher for some of these stable coins like Tether and USDC. And if we look at the most recent published rates for BlockFi, which is another large platform, you can see that it's actually tiered. So for the first quarter of a Bitcoin which you hold on the platform, you'll get an annual percentage yield of 4%. But for the next quarter of a Bitcoin up to 5 Bitcoin, the yield is smaller. So that's only 1.5%. And that tiering also applies to other cryptocurrency holdings. And if you're on the Coinbase platform, you also get rewards for some cryptocurrencies. Some of these are for staking, so for example Cosmos, and some of the rewards are just built into the token itself, as is the case for Algorand. But it's worth saying that if you're on Coinbase Pro, you don't receive these rewards. It's also worth reading the small print on some of these platforms because you could be paying quite a high commission. So for example, on Coinbase, you'll be paying a fairly chunky 25% commission on any rewards which they generate. Now, before I go on, I should thank my community in PensionCraft for helping me learn about how to do this. So this comment was taken from our crypto Slack channel, where somebody's warning me that USDC is probably better than USDT because it's a much more transparent stablecoin. So if you want to benefit from our network of very knowledgeable people, both on the crypto channel and the general investing channels, then you can always become a member. If you do want to do that, you'll get access to Slack and lots of members-only videos. So if you want to learn more about that, just click on the link in the description and the link beside me to become a Patreon supporter and get access to all those goodies. Now let's get on to the practicalities of how you do yield farming. And we'll start off with staking on Coinbase. Now, in order to clamp down on things like money laundering, but also illegal activity, a lot of these platforms are insisting on verification. So for example, I needed to upload photo ID in the form of my driving license. And to earn yield from staking, you have to own a cryptocurrency which allows that. Now, if you do generate a capital gain or income, that will be liable to income tax and capital gains tax, which means that you also have to provide a TIN, which is a tax identification number. That's certainly true if you're in the UK or if you're in the US. Now, these are the 4 cryptocurrencies on Coinbase where you can generate rewards. I found that on the UK platform, you can't stake Ethereum, at least not yet. But you'll notice that the rewards payout rate is also different for the different cryptocurrencies. So for example, Algorand pays out daily, whereas Atom only pays out every 7 days. Plus, you do need to have a small minimum holding for some of these cryptocurrencies. Another thing you have to do on Coinbase is go to Settings, go to Financial Services and switch on rewards for the 4 eligible cryptocurrencies. If you don't switch it on, you don't get the reward. And the fruit of all that labour, in my case at least, is 46 pence so far. Now, I didn't put much into this account, so I wouldn't expect much in terms of rewards, but that's my 4% annual yield in action. Now, if I'd have put my money into Cosmos, you can see that my annual percentage yield would be slightly higher at the moment at 5%. So if you do this very seriously, you might move your currency around based on where you get the highest yield. Now, one of the things I don't like about staking is the payment is paid in the cryptocurrency itself. And as you can see here, if you look at the price of Algo, that's very volatile. It's up 121% since the beginning of last year, but it's also fallen by over 50% since its previous peak. So there's always the risk that the reward you're paid eventually becomes worthless, or at least that it crashes in value. And if you plot the volatility of various cryptocurrencies, this is the typical annual percentage price move for each of the cryptocurrencies. You can see they vary between about 62% for Bitcoin all the way up to about 300% for Dogecoin. So what I found particularly interesting was that you can get fairly high yields for stablecoin. These are cryptocurrencies which are tied to the value of a currency like the US dollar or sterling. Now here, the risk-adjusted return is actually very high. The volatility for these 2 stablecoins is only around 1%. And yield farming with stablecoin is exactly what I tried to do on BlockFi. Now, BlockFi is a US platform, and the first problem I ran into was that I had to convert my sterling into dollars and then move that over as a wire transfer. But I chose another route, which is to buy my USDC, which is a stablecoin, on a cryptocurrency exchange, and then transfer that USDC over to BlockFi. So I put some money into my Coinbase Pro account, which is usually quite good in terms of fees. And at 9:34, while I was sitting in front of the TV with my partner Laura, I set up a transaction to buy USDC for a price of 0.719. Now, it took a while before the first part of the trade was filled. It was 10:40, but then by 11:30, the entire order had been filled. And when I checked the currency rate with what I could see on TradingView, that was pretty much in line with the current rate at that time. So at least I wasn't being gouged on the conversion from fiat to USDC. Then the following morning, I decided to transfer my USDC from Coinbase Pro to BlockFi. And you can see it happened fairly quickly. So I started the deposit at 9:42 and 6 minutes later, the deposit was confirmed on BlockFi. And at least so far, it seems to be working out okay. So I've made $1.38 over the course of 5 days, which I calculate to be a rate of just over 7.5%, which is pretty much in line with their quoted yield, which is 7.5%. Another platform I tried was Nexo. Now, what I initially liked about Nexo was that I could take money from my bank in the UK and transfer it directly into my Nexo account. But I got this warning from my bank saying that this payment is high risk, stop now. And that certainly worried me. I was also worried by the fact that the transaction took over 3 days, but eventually the money did end up in my Nexo account. So this is what it looked like when my money went into Nexo. It's classified as top up fiat. And here's the £3,000 which I put into the account. Now what's interesting is what happened a minute later. So the money went into the account at 8:17, but at 8:18, Nexo converted my sterling into their own stablecoin for sterling, which is GBPX. And as we'll see later, I probably should have just stopped there. The next transaction I did was to buy some Nexo token, because a deal on Nexo is if you buy some of their own token, you get a high yield for your other investments. So I dutifully bought 272 Nexo tokens, which was about 10% of my investment. And then with the remaining £2,700, I bought USDT, which is Tether. Now by doing that, I was suddenly taking the currency risk between sterling and the US dollar. And the risk, of course, is that sterling strengthens versus the dollar, and I effectively get a capital loss in this account. So what would have made more sense would be to keep it in the sterling stablecoin. And you can see later on that's exactly what I did. And apparently the yield on that will be comparable with what it would have been for Tether. Although unfortunately here they're fairly vague about the rate, up to 12%. Now at this point I would have liked to have shown you Celsius, which is another platform, but unfortunately they didn't let me. Because just when I wanted to validate my account with them, they decided to move their business activities from the UK to the US. And following that decision, they decided to close registration for new customers residing in the UK. But don't panic if you're an existing customer of Celsius, apparently you're not affected. Let me end by just tempering your enthusiasm with the huge risks you're taking with yield farming. And yes, you are taking huge risks. The risk of capital loss is extremely high, even if you do your due diligence on the platforms themselves. So for starters, there are no government guarantees. So for example, if you put money into a cash account in the UK or the US, up to a certain level, it's guaranteed by the government. So even if the bank goes bankrupt, you'll get a certain amount of your money back. But there is no financial services compensation scheme or FDIC for crypto. Some of the platforms say they've got insurance, so it's worthwhile checking those out, but you never know the true value of those guarantees until a crisis actually hits. Now, if you do receive payment in kind, in other words, you're paid a yield in cryptocurrency, then you will have to weather that volatility. And that certainly comes with a big risk. We've seen multiple times that cryptocurrency crashes very rapidly and very severely. But at least you can mitigate that risk by having something like a stablecoin. Now, the platforms we've looked at could themselves be hacked. And if that happens, we could be looking at a very significant loss of capital. And as the amount of money increases on these platforms, the incentive for hackers to hack them must become much greater. Another problem is regulatory risk. So for example, the Binance platform has run up against some regulators recently, and some investors had difficulty taking their money off the platform. Plus, there have been rumblings in Congress about Tether and how it may destabilize the US financial system. So there's always the risk that regulators will clamp down on cryptocurrency, and that may affect prices, but it may also affect the ability to withdraw your money into a normal bank account. I tried to make this video easy to understand, but I think in many cases, yield farming is very complex, and it's always a good idea not to invest in something unless you at least understand part of it. And until there's some kind of vanguard of cryptocurrency platforms, I'm still very wary of the high fees that you can pay for many of these platforms. And one example of that is just converting your money from fiat into cryptocurrency and back again. So I hope that's given you a taste of what it's like to do yield farming in practice, but also the very large risks you're taking when you do that. And if you do want to support us on Patreon, I'll just remind you, you can do that by clicking on the link in the description and the link beside me. And as always, thank you for listening.